example, like I said, it's 17 week out on 7.5 cut weight steers and heifers. Again, you could do endorsements for 13 to 39 weeks. In this instance, we did it for 17 weeks, which would take you out to June 3rd. This is what, as of yesterday, the CME index reflected for May feeder cattle, which was 266.17, and since this interval gets you to June 3rd, we just based it off of what the May CME index was. This is heifers, so here, let me fast forward to steers real fast. So here you're showing, right here, if you're insuring at 100%, you're at exactly that 100% mark of where the CME index closed at 266, taking you to June 3rd. Now, you can sell 60 days before or 60 days after where that mark is. When you guys sell, that isn't so much contingent as opposed to when and that date of June 3rd of where the markets close at. So if the markets close, it's based off of an index. So if the index closes below that 266.13, you guys trigger an indemnity. It insures you up to almost $2,000 a head. The premium, the total premium is $100. So in this instance, you can see that the government, and as Rich said the last meeting, he doesn't like the S word subsidy, so we're going to use the government copay. The word government copay is 35%, which then makes your premium $65. So it's $65 a head to insure basically $2,000. Wow. On heifers, which they are, worth a little bit less than what the steer market is, you would be able to insure $1,796, so almost $1,800, and your premium would be $58. So less guarantee, clearly then less premium on that. But you could also go up to 8 cut weight. We could play around with whatever weights you want to do. We could mess around with however long your intervals are. The longer your interval is, the longer your insurance period is, then clearly the higher your premium will be. You could also do fat cattle. But in this example, I just kind of picked steers and heifers at 7.5 cut weight for 17 weeks out. Does anybody have any questions on that?
So you collect on it just if they die?
So that's a great question, Grant. So say as though you insure 30 head, and unfortunately, say 3 of them don't make it. So as long as you let your agent know within 72 hours of the death loss, your coverage is still binding. So all we do is just submit a record that says, hey, unfortunately you had 3 count death loss, whatever, your insurance is still binding on that. Another question that I ran into with someone that triggered an indemnity on the last one was they had heifers insured, and instead of selling the heifers, they decided they wanted to keep them as replacement heifers. Okay, well, what do you do there? Because if you trigger an indemnity, you need to show sales receipts or some sort of form of documentation that you do have that livestock. So all they did was have a feed nutritionalist or a veterinarian show up at their site, at their barn, and just say, okay, yep, I see 20 head of replacement heifers out there. Here's your documentation. Here's what I submitted to the RMA, and indemnity paid. So it seems to be pretty popular, especially with the way that the livestock market has certainly been. And anytime you could insure almost $2,000 worth of a guarantee for $65 a head, that's really not a bad investment in case something drastically or dramatic happens within the market. So basically it's just like a put option. You're just putting the floor in on what your pricing is. Good question. Any other questions on LRP? And then I have another slide about pasture insurance, which is otherwise known as PRF, pasture rangeland forage. And the sales closing for 2025 has surpassed for that, but for 2026, the sales closing would be December 1st, and that's basically insuring against drought. So if you bale a lot of hay, if you graze a lot of cattle, however, it's just a way to basically protect your bottom dollar investment if you have to go out and purchase hay or elsewhere. So it's in 60-day intervals. You could pick, say, May and June or June and July, any time in 30 or 60-day increments. And if it doesn't rain within those 60 days, you trigger a payment. Sales closing for that is December 1st. So we've already closed on that, but we wanted to kind of give a high-level overview of some of the livestock insurance programs that we do offer within Ursa Farmers and NAU. So having said that, I'm gonna pass the torch to Peggy Dusterhouse, and she's gonna talk about a little bit of replant options.
So everybody's multi-peril policy has a replant portion in it. And what I'm going to talk about here is a way to give a little more coverage just because costs are different. So the replant option is going to allow you to replant, allows you a replant payment if you plant before the initial plant date. So the last few years, we've seen a lot of people planting early beans. Well, one of the reasons you don't want to plant early is if they get froze and you have to, replant. If you take this replant option, it will allow you to replant it will allow you to plant 15 days before the initial planting day. So the basic multi-peril policy has well, here's the early plant dates for everybody. The whole United States, and we're in the April 5th for corn, and on beans, we're also in the April 5th area. So here, the early plant date for our area, I said, was April 5th. The basic multi-peril policy, if you plant April 5th and you have to replant, for corn, you're going to get 8 bushels times the February price, which is $4.65, or that's around where it is now. With the basic multi-peril, you have to meet the requirement of 20 acres or 20% of the unit. If you buy the extra replant option, you do not have to meet. If you replant 1 acre, we're going to pay you. You have to pay the replant premium on all the acres, but you do get paid even if you don't make that 20 acres or 20%, and you get paid if you plant 15 days early and you have to replant. So here's some examples. Farmer A plants corn on March 15th. If he has to replant, it's going to be at his own expense. Farmer B plants corn on March 17th. If he has to replant, he will get X per acre on acres to replant. Your X per acre is in the middle part of there. You can pick $20 an acre, $30, $40, $50, or $75 an acre extra for a replant payment. Farmer C plants corn on April 5th. He has to replant. He's going to get that X per acre plus the basic multi-peril replant payment of 8 bushels times the corn price, or $36 an acre. Bean plant dates, they've changed those a little bit, and we do have now an early plant date of April 5th. But if you take that replant option, you can plant 15 days before that April 5th. And it's the same thing, it allows you to pick 20, 30, 40, 50, or $75. So if the conditions are right, and you want to plant, I always tell people to plant, don't worry about that date. If the conditions are right, that's what you should be doing. But maybe a little more to make you feel better about planting is if you take this replant option. If you're going to give you $75 an acre and you want to start planting on March 30th, you've got a guarantee or a backup that you're at least going to get $75 an acre if you have to replant any of the acres. And it's going to cost you $2 to get that. But you got to pay the $2 on all your acres. And your replant payment will just be on what has to be replanted.
Peggy, shouldn't that date be March 20th?
For the,
To work? 'Cause
for
March
the
17th,
15
they
days.
shouldn't get paid.
15 days before April 5th,
It's March 20th.
20th. Yep, you're right. It should be March 20th.
And one other thing to point out, you could take this replant option that Peggy's talking about on just your beans.
Yes.
Or you could take it out on just your corn. You do not have to take it out on both commodities. So if you are anticipating planting beans early, and you know that you may not anticipate planting corn early or whatnot, then you could just take them out on your beans only.
Mm-hmm. Right. Any other questions? And I had that date wrong of April 1st, and that's why I had the March 17th. So I corrected the April to April 5th, but then I forgot to correct the one above it, so. But the basic multi-peril, you have to have 20 acres or 20% of a unit. But what is nice on this extra replant option is you get paid on acre 1. And one thing to know, the extra replant option, that is different with each insurance company there is. Different insurance companies may only give you 10 days, or they may have different different numbers. NAU, we have 15 days, and you don't have to pay the premium until October or September, the end of September when you pay your other premium. Any other questions on the replant? Something else I want to mention is, that's changed in the last few years, is double crop beans. So there is now a code, it's an endorsement, it's labeled EC, which allows you to insure double crop beans as a separate crop from regular season beans. And you can only do that in Adams County and South. If you were in Hancock County, they would put those both together unless you did optional units, which is keeping each section separate. The T yield for Adams County double crop beans is 43. Another place you can use that is if you've got triticale or rye that you bale for hay and you don't get it cut until after it heads, then it's considered double crop. But if you cut it early for hay before the head, then it's considered full season beans. Any questions on this? So now what I want to talk about just a little bit is the ECO. You've probably been reading or hearing a lot about this in some of the magazines and stuff that's online. The big reason that everybody's talking about ECO is because the subsidy rate changed from 65%, went up to 65% from 44%. It allows you to do an area-based coverage, which means it's not on your individual farm's yields, it is on what the county does. But you can insure from 86 to 90 or 95%. It doesn't matter what program you pick at the FSA office, and Rich is going to go into those a little bit later. Your payments are determined on whether the yield and the revenue for the county fall below the expected level. The bad part about it is that you don't get the payments till June of 26. So if you sign up for ECO this year, you won't get a payment till June of 26. Part of that is because they don't announce Adams County yield until April. And so that's why they have a delay in the payment. So ECO, you could pick 90 or 95%. The red is the no deductible. That's on you. The green is where the ECO band is, and that's the county coverage. There is also an SCO band in there. You can choose just to take the green band, that higher level, because that's where it's going to hit first in a payment to you, and leave that middle part blank and not take the coverage if you want to cheapen up your insurance a little bit. I mean, each one of these costs. So the SCO coverage that you take, that is dependent on what you do at the FSA office, that yellow one. The yellow one goes from 86% down to what your coverage is on your farm. So if you go to 75% on your own individual farm, you're going to be from 75 to 86. If you take 85% on your own farm, you're only going to pay for 1% coverage. So here is an example of what it cost for last year if you were doing the ECO and what it shows this year. And this is Adams County, so it's almost a $10 savings per acre. And on beans, it's around $7. And those numbers aren't locked in because it's based on what happens during the month of February with the prices and the volatility that happens at the end of the month. Here's just a real quick example on your crop insurance premium. If you go 85%, and this example is a basic unit. It is the APH of 184, and then it's the price of the 465 we're at. So you might say that sounds high, but if you go enterprise, you could be looking at half that cost. But the 85% level, we've got $35.60. The SCO for this policy would be $1.22. You can see if you went on your own policy 80%, that premium goes up to $6, but that's because you're covering 6% from 80 to 86 level. You have two options on which ECO you want to add. If you want to cheapen up your premium, you could do 80% level, then take the 95% trigger. You don't have to do those in line the way I've got. Another way to cheapen up that ECO is you can say I want half the liability. I still want a payment as soon as I get below 95%, but maybe I don't want to pay $15, I only want to pay $7.50. You can do that, and then if there is a payment to you of $20 an acre, you're only going to get 10 if you change the liability. But you're still collecting as soon as it gets below 95% coverage. It's just a way if you want to try it out, you know, not to have to spend that many dollars per acre. You do have to take it on all your acres of the crop you decide. You could say, yes, I want it on corn and no on beans, or vice versa. Or you can take it on both. Just kind of wanted to give you a little bit of an overview. That's something that you'll be hearing about a lot. Is there any questions on this? All right, I am going to turn it over to Rich. Rich Morrison has been with NAU for 5 years. He's been, he goes around to different locations and does meetings like this, mostly marketing meetings, but he has a good way of tying the crop insurance with the marketing together, and then he's also going to give us some information on the PLC program and the ARC that you got to go to the FSA office. I feel like I've got a mouthful of alphabets when I'm talking about all of these. Unplug this and
All right, well, thank you all for coming out today, and as Peggy said, we're going to talk about markets quite a bit, but also talk about the other parts of the risk management triangle, I guess I call it. Second time today this has been.
It worked for us.
That's weird.
do you want?
I got a different clickers. So. All right, so this is kind of what I do with NAU Country, not just focus on grain marketing, but also on the other pieces, the crop insurance, the government programs, how they all fit together, and hopefully help farmers be able to build a plan for the year that's going to be successful. And so,
Do you want
Do
me
you want to
to?
use ours?
maybe,
Wow.
There just went up. Yeah, went ahead like 4 slides. So, to me, we'll start out talking about markets. To me, the biggest factors we've got to deal with right now. We're still getting the benefit of the USDA January crop report. That was about 4 weeks ago now, but we got some big surprises from the government on production, and so that's definitely a big factor for us. That's been positive. Secondly, the South American crops right now, pretty important time of the year. And so, that's not clicking.
That's not working either? Maybe it's your USB.
Thank you.
Here, you want us to just do it next?
You want us to hit the?
All right. Oh.
There we go.
All
Maybe it's
right.
your USB.
Maybe it is. It's kind of like the early part of August down there right now, so pretty important time. Brazil's trying to harvest beans, and Argentina's trying to hopefully get some rain to finish the crop out. So we'll talk about that. The macro markets, the US dollar, crude oil, those markets tend to be pretty important for how things trade in the grain, so we'll look at those here in a minute. The managed funds. We curse these people when they sell, and we are happy when they're buyers. Right at the moment, they've been buyers, so we'll look at their positions in the market. And then lastly, tariffs and trade. Really, this has been as big as anything here as of late. You can see this is a pretty good chart showing our ag exports to and from, or exports and imports, I guess not ag, overall exports and imports from really the big 3 countries we're talking about with tariffs right now. So we export more to those countries than we do import-wise, so certainly a big deal for the marketplace. So I mentioned the dollar a minute ago, and the dollar had been on a huge run, you know, from probably the 1st of October all the way through the beginning of January. And I think some of that started prior to the election, but when there was some inkling of that Donald Trump was going to win the election, and I think people started building some enthusiasm into the markets, and we rallied the dollar nearly 10 percentage points. That's a good thing if you're traveling to Europe on vacation. It's not a good thing if you're trying to compete with the Brazilians for a Chinese bean market, because it's making Brazilian beans a lot cheaper. Now the dollar has corrected just a little bit off the highs, but you can see what the impact was on the strong dollar in 2024 versus some other currencies. And the big one was the Brazilian real. It fell nearly 22% versus the dollar last year. And so that's kind of like swimming upstream. You know, it made our beans a lot more expensive relative to Brazilian beans. The crude oil market, oil had been on a heck of a run, rallied $13 a barrel from the beginning of December into early January. I think a lot of that was inflation related. I think a lot of it was expectations or hope for some good economic things to continue. But we have seen a correction. And I think part of that was because of the drill baby drill mantra from President Trump. And I think part of it was maybe thoughts that OPEC plus would probably increase production. I don't know if they're going to or not, but it sounds like they may wait until spring to do it a little bit. But regardless, the market has corrected back down. One of the reasons I want to show oil tends to be a pretty good correlation with corn over time. If you look at the last 10 years, it's maybe not on the daily chart, but on the monthly charts especially, they tend to track each other pretty closely. So I always keep an eye on the oil market. It tends to be a driver for where corn's going. Cattle, Susie talked a little bit about the cattle market. We've traded to all-time highs here this month. It's been an incredible run in the live market, in the feeder market as well, making new highs here just as of late. We have corrected a little bit. It's a pretty good time to point out on my charts, I always include the relative strength index and the stochastics lines on the bottom of the chart. And the RSI and the stochastics both kind of measure the same thing. They're a measure of the volume of trade in an ascending or descending market. And so I always compare the RSI to a wooden roller coaster, because when you're going up a hill, when you start up the hill, you got a lot of speed, a lot of momentum. What happens as you get close to the top though? You start to slow down. You almost come to a stop before you pick up speed going back down again. And that's really what this measures. It's the volume of trade as a market's going up or going down. And as you get towards a high, the volume starts to slow down a lot. You just see less buyers. Nobody wants to buy. Not as many people want to buy 279 that wanted to buy 222. So that's what this measures. And when the RSI hits into the upper 60s or 70, the red dotted line, that's considered to be a sell signal. RSI hits the blue at the bottom, the 30, that's considered to be a buy signal. Historically, those indicators work really well. May not hit the right day necessarily, because you can see we've had several times over a month where the RSI was pushing into overbought status. But over time, if you follow these, they tend to be pretty good indicators. And so that brings us back to the LRP discussion. Susie talked about livestock risk protection, and I think this is the type of a market that this is made for. You know, it's basically like a put option. You're buying a floor under your cattle. If the market goes higher, fantastic. If they don't, then you've at least got something put in place in case the market trades lower. So I'd invite you to check that out. On corn, the big surprise back on the 10th of January was the USDA report. The yield came in 3.8 bushel less than what the government had back in November. Huge shock. That was tied for the biggest change we've ever had from November to January. 2020, we also saw a similar drop from November to January. The trade expecting nothing near that big. You can see here the red states indicate states that dropped. The green states went up a little bit in the January crop report. Illinois ended up at 217. That's the final yield for the year. That was down a bushel from where we were last month. The states that have a pound sign had records. So Illinois, Iowa, South Dakota, Michigan, New York, Arkansas, and Louisiana all had record state yields here this year. But that drop in production, this is USDA's estimate right here. This is every analyst estimate going into the report. Everybody was over expected, on yield going into that report. Consequently, when the numbers came out, if you look at the average up here around 15.1, here we are down below 14.9. So we were 200 million plus below what the average trade estimate was. And so it was very bullish when the report came out. So here are the balance sheet numbers from that report here on the right. Yield production dropped in this report. USDA did make a slight cut to the feed demand, made a slight cut to export demand, but ending stocks ended up at 1.54 billion bushels. Just about 6 months ago, this was over 2.2 billion bushels. So we went from a situation 6 months ago of swimming in corn, potentially, to all of a sudden being a little bit on the snug side. Now 1540 is not tight, but it's a heck of a lot smaller than what we were talking about at one point. The big positive, two big things that happened. You know, it's kind of a perfect storm really for this market because number one, USDA lowered the production, and number two, this export number is the highest it's been in 3 years. And that's been a big shock. You go back 6 months ago, we weren't expecting that. But this is back to the level we were 3 years ago when China was buying US corn. China's not buying any US corn this year, and still the export numbers are up. And kind of shows it right here. Our export sales so far year to date have been running way ahead of the 5-year average, way ahead of last year. The argument is, or the question is, are the sales all front loaded early in the year? Are they going to slow down? Or is this pace going to continue? You can see by country, you know, which countries have been buying, and it's everybody, all the major importers, Mexico, Japan, Colombia, well, unknown, and the rest of the world. South Korea is one of our bigger ones, but everybody so far has been buying more US corn. And so why has that been the case? I think two reasons. Number one, if you go back to the beginning of our marketing year, September 1st, where was the price of corn at that point? You know, we were down below $4 at one point at the end of the summer. So we had very cheap price, and I think that got a lot of these people on board early. Number two, you had countries like Mexico who were afraid of what? Tariffs, right? So they've probably been front-loading purchases. Now that we had this 30-day extension, it shouldn't be a surprise. Mexico came in the market this morning, bought 300,000 tons of U.S. corn. So they're, you know, trying to play that game a little bit as well. The question is, will this continue, this pace? If so, will USDA raise its estimate for the year? But it's been a big positive for the corn market. And if you look at the world numbers, the rest of the world, the major exporters in the world, don't have a ton of corn around. South America, you go down to Argentina, Brazil, don't have a lot of extra corn this year. Ukraine, they kind of are what they are. They've been shipping a lot of their corn locally. China's been a big buyer of Ukrainian corn. But at the world level, stocks to usage are going to be down a little bit this year. So again, part of the reason I think we've seen this perfect storm in the corn market. And so here's a snapshot of what the managed funds have done in the corn market. First, before we look at where they're at today, go back to the yellow and the purple lines up at the top of the orange. That shows where they were back in 21 and 22. They were long, near record amounts of corn. I think the biggest long position the funds have ever held, I believe, was in 2011. They were long about 450,000 contracts at one point. Here they were back just a couple of years back, long close to 400,000 contracts. This is when China started buying U.S. corn. Our stocks started to drop, got tighter, and it took a while to rebuild stocks, but the funds were exuberant. They were the ones that gave this big rally in the corn market. Fast forward into 22, 23, and as we started building stocks of corn up, funds decided, you know what, we're better to take our money and put it somewhere else. They went to the short side of the corn market. All of last year in the red, they were on the short side of the market. And as of last July, they were holding a record short position in corn futures. They were down to about 350,000 contracts short. Since then, it's been a heck of a turnabout. You know, they've been on a huge buying run in corn. A few reasons. You know, I think that the funds give these people some credit. I think they saw what was going on quicker than USDA did this year. That you had Mexico and several of the importing countries coming in early and buying a bunch of U.S. corn. And then you couple that with the smaller crop size here this year, and the funds have continued to buy. And as of last Friday, now they're long 350,000 contracts of corn. So it's been a huge flip. You know, you go from 350 short to 350 long. That's 3.5 billion bushels of corn that they bought in the last 6 months. So give these people credit. If you look at the March corn futures, you know, you go back here to the summer, this is when they started buying. Now, some of their buying was offset by periods of heavy producer selling, like here in harvest, and again, maybe a little bit post-harvest, but it's been a heck of a run in March futures. Even, beginning of December, right after Thanksgiving, we were down at 4 1/4. Things weren't looking too hot. And then all of a sudden, you started seeing the market. I think this was the oil market that helped spur the rally in corn. Here was USDA report day when the market spiked, and we really haven't looked back much since. We're still sitting above the 9-day moving average, this red line. Even this morning, the market's down 3. I just updated the chart a few minutes ago. Did make a new high overnight, 498.5. That's the highest we've traded since clear back in May. So I think it's a fantastic opportunity for farmers to be selling some corn into this rally. I'm sure people have been, because we've seen what happened to the basis over the last month. Basis levels have certainly widened as we've seen a lot of cash grain getting sold. But if I'm looking to make sales now, I'm probably going out to maybe May or even July futures. I think May corn was 508 yesterday or something like that. So there's a hefty carry in the market right now, driven by all this old crop corn that's been sold. But I think it's a great place to reward the market. And if you look at the indicators at the bottom of the chart, you know, the RSI's been knocking on the door of 70s, stochastics been up in the 70s, 80s. So this market's, you know, kind of telling you, reward it, take advantage of the rally. Looking ahead to next year, or the 25 crop, I've got 3 different alternative balance sheets. The first one, this was all Informa Commodities acreage estimate at 93.5 million acres this year. The second one, I plugged in 94.6, which is what we planted a year ago. What if we just flip back to last year's numbers? Flip corn back to 94.6, beans go back to last year. I think there's a lot of talk about that in parts of the country, especially in the northwestern parts of the Corn Belt. You get up in the Dakotas and Minnesota, they had a very wet spring last year. And a lot of that corn didn't get planted, a lot of it went to soybeans. I was talking to a gentleman from Minnesota yesterday, North Dakota last week. They think they're going to plant the heck out of corn this year. The third alternative I had, what if we plant our record number of corn acres, 97.2. That was back in, I think, 2012, we planted 97.2. I don't know that we're going to get there. I have seen some people talk. I read one guy said 98 million acres this year. I think the first liar doesn't stand a chance, right? So somebody's always going to want to be bigger. But could it happen? Well, I mean, look at the insurance prices right now as a starter. The corn price, crop insurance price, we're 2 days in, basically identical to last year. But beans are running about 90 cents below last year. That ought to tell you something, at least as far as what profitability would look like from one crop to the other. So we'll see. But if I plug in what I would call a trend type yield, I'm not quite as high as USDA is probably going to use. They're probably going to use 182. I'm starting at 181, and if my acres go up, I'm dropping that yield down a little bit. All 3 of those would give you a good production number. I'm pretty bullish on demand for next year. I don't see a reason demand should stop. Feed's probably going to stay steady if cattle, hog numbers stay steady. Ethanol, probably going to continue to run at capacity, a little over 5.5 billion bushels. And even exports, I think, will still stay firm. I don't see a situation where Brazil or Argentina is going to have a massive amount of corn to be selling. So I still think we're going to stay firm there. Even with strong demand, now you're looking at potentially pushing up over 2 billion bushel carryout next year. So it'll be interesting to see. USDA will come out with its updated baseline numbers here, I think the 3rd week of February, so in a couple of weeks. That'll be interesting to see what they're using for acres and a balance sheet. At the end of March, we get our planting intentions report from the government. So that'll be actually based on surveys of producers. So it'll be very interesting to see what they're using at that time. But as I look ahead to December corn, only a month and a half, 2 months ago, we were trading down, making a double bottom down here at 428. Balance sheets didn't look very good on the farm at that point, but things have rebounded a little bit. We're 40 cents off the low right now. Again, if you look at the stochastics and the RSI, it'd probably tell you that it's a good time to reward the market. I think so. I think it's not a bad place to get started on a sale. and maybe scale up. If we go up a dime, sell another 10% or something. But I think we're far better shape than what we had assumed we would be. And if you think there's a chance we're going to plant 95 million acres this year and see, you know, possibly a 2 billion carryover again, then I would be happy to have some corn sold at this level. So if you can pencil it in your balance sheet, make some money here, I think it makes some sense to start doing it. The other thing I want to point out on these charts, you know, we always like to sell rallies. How many rallies have we had? You know, you look at December 25 corn, I consider a rally, you know, when the RSI got up close to 70, and really we only had 3 in the last 8 months. So we don't seem to get a lot of them anymore. The markets seem to have these big, long waves up and down. We don't see the back and forth. So I do want to take advantage of the ones I get. The other thing I'd point out is the historical pattern of corn futures. You look at last year in gold, the 3, the 5, and the 10-year average, you know, really from February to June is your best window to be marketing corn. And I know most of us don't want to sell a lot at one time, right? Nobody wants to wait till June 1 to sell 50% of the crop. So I think it's a good place to be chipping in and selling the rallies. I also recognize that you get past about the middle of June on, not a good time to be selling corn. So kind of think about that in old crop as well. You know, anybody that held corn into August last year, that didn't work out very well. So I don't want to be, you know, doing that again this year. Soybeans. Look at the report on the 10th, very similar to the corn report. We were surprised USDA lowered the yield a bushel an acre, which is a huge drop, almost a 2% drop. The pink states, red states all went down, green states went up. The Illinois state yield was 64, that was down a bushel from back in November. We only had 2 states with records, those were Arkansas and Mississippi. So I would say overall the bean crop was a little more disappointing than corn in a lot of places. And if you look at the estimate, here was USDA's number, here were all the trade numbers going into the report. So again, everybody was guessing we would have a higher number. That didn't happen, thus the bullish reaction. And if you look at the balance sheet, USDA really only made one significant change. That was lowering the yield of production. That took ending stocks down to 380 million bushels. Now, this is still a 4-year high. So, but I would use the term, I would say it's less bearish than it was going into the report when we were 450 million last month. And at one point we were 550 million here. So, again, it's not a bullish scenario. You're not down at 250 where you're tight beans. We're going to have enough beans. It's just a matter of not having as big of a carryover as what we had thought. 2 sets of numbers to really look at on the bean balance sheet. Number 1 is the crush. This domestic crush is a record. We're setting new records every month right now. And that's because we've got new plants that are coming online. We've had several new plants come on board this last year. We've got several that are coming on board. I'll get to that. We'll skip ahead and then I'll skip back. Last month's crush back in December, record high for any month, an incredible number. And if you look at the plants, you can see in green, these are the ones that have come on board in the last year. And then these blue ones are going to come on board in 25 and 26. So we're going to expand our capacity for soybean crush in the United States. That's a great deal because when you look back at the balance sheet, where we're struggling is on the export side. Now this is not news. We've talked about this for a couple of years that we don't expect exports to grow a whole lot because as Brazil production continues to grow, they're going to buy more beans from, or they're going to sell more beans to China. So we don't expect growth here, even though it was up last year. This number is 300 million below where we were just 3 years before. So, but we need to make up the ground here on the domestic crush side. So those are kind of the numbers that we're watching there on the balance sheet. If you look at the export commitments so far year to date, we're running below the 5-year average. We are up a little bit from last year, but it's nothing stellar at this point. And you can kind of understand why. If you look right here, why we don't expect exports to be that great. The pink bars on here are the value of U.S. soybeans delivered to China, and the green bars are the value of Brazilian beans delivered to China. So if you're a Chinese feeder, soybean crusher, and you're going to buy beans, who do you want to buy them from right now? You're definitely going to buy Brazilian beans if you can. And for the next 6 months at least, you're going to buy Brazilian beans. And I think this is going to extend on into fall. because they're gonna harvest 170 million tons of beans in Brazil. They've never harvested a crop that big. They're gonna have a lot of beans to ship. And so I think this tough competition is gonna extend out into our harvest window. So kind of keep that in mind. If you're selling new crop beans out of the field, you know, look at the basis and see where you think that's at. If you can lock in a good basis, maybe not a bad idea to get that done. So looking at overall the big three, this chart shows the big production between the United States in red, Argentina in blue, Brazil in green. Between the three countries, going to have a record production this year. Now that number may come down slightly. This Argentine crop may not get to 52 million tons. Sounds like they're probably going to be in the low to mid, or the mid to upper 40s because of drought, probably taking the top off the crop. The Brazilian crop at 169, most estimates I've seen lately have been 170 to 174. So they may have some issues with quality because of rain, but sounds like they got a lot of bushels. So we'll see what ends up happening. Point is, you can take 4, 5, 6 million tons off of here. Right now we're forecasting to be a record by 26 million tons above last year. So it's going to be a big crop. Question is, how many bushels are we going to end up with? If you look at the South American harvest right now, Brazil's harvesting beans. They're 8% done as of last week. Normally they're about 20% done in the week ahead. So they got some catching up to do. The other place that this comes in, well, a couple of things this has an impact. As you go into the Brazilian harvest, the Chinese buyers all have boats lined up, getting ready to load down there. And so the later they are at harvest, the more those boats are delayed. So kind of keep that in mind. But they're ramped up, ready to ship. The other thing that happens right after the soybeans are harvested in Brazil, they plant their second corn crop. About 75% of the corn in Brazil is planted following soybeans. So the later they are at harvesting beans, the later that corn is. And normally they want to plant corn as early as they can because you get out into March, April, that tends to be their dry season. So they want to take advantage of the moisture when they can get it in the ground. So we're watching this on a weekly basis. Now, if you look at the last 14 days, that's very wet. Here's Brazil. Here's the state of Mato Grosso right here in the middle. That's the biggest producing state. I think I saw territory-wise, Mato Grosso is the size of Illinois, Indiana, and Iowa combined. So it's incredible how much, you know, there's your I-states right there. And it's been wet over the last 14 days. So harvest has been pretty hit and miss getting going. You get down into Argentina, they've been struggling. The last 2 months have been very dry. They have had some rains show up. The last 24 hours, I don't think that's in here, but they have got some pretty decent rains in eastern Argentina in the last 24 hours. So that might stop the bleeding as far as their crops go. Looking ahead, kind of hit and miss. Argentina looks like they're going to dry out again over the next 7, and I've seen a 14-day forecast. It looks like not much rain. As you get up here into Brazil, maybe kind of some heavy rain again in central Brazil. So that could slow the harvest down there a little bit. At the moment, it appears that the market today is trading last night's rains in Argentina because the market was down pretty hard here today. If you look at the big picture of beans, you know, we look at the U.S. numbers, but I think in beans as we go forward, we're going to continue to focus more and more on the world numbers. World ending stocks are going to be at a record this year. And even if you were to shave a little bit off the production, there's still going to be at a record number this year. One of the areas of concern, and somebody brought this up this morning, is China. That China's demand is not growing. While production at the world level continues to grow, the Chinese demand is really not growing. Pig numbers aren't changing down over there. They just don't have that extra demand at this point. So that's a concern as long as we continue to grow more and more acres of soybeans. So here's a snapshot of what the funds have done in the soybean market. You know, you go back 2-3 years ago, they were holding a big long position in soybeans. About this time a year ago, they finally went short the market, stayed short all year. As of the beginning of the marketing year, they were still holding a big short position. A couple of things caused them to buy back that short. Number one, this is when we had a big rally in the palm oil market. Malaysian palm oil production was down sharply this year. That brought some demand to the world to buy soybean oil for human consumption going to Southeast Asia. And so when the bean oil market started to rally, funds started buying beans. Then, here this winter, we had the USDA report, we had Argentine dry weather that caused the funds to go from short back to the long side of the market again. So, again, I would ask the question, what will the funds do at this point? You know, kind of like corn, they were holding that huge long position. Beans are holding a big long as well. I tend to think if I were a hedge fund trader, I wouldn't want to be long a bunch of beans as we're about ready to harvest a huge Brazilian bean crop. That's just me, but kind of like here in the US, I don't like being long right ahead of harvest. So I don't know. I would tend to think you'd see some selling from these folks. And maybe that's part of what today is. We had March beans down 17 just a few minutes ago. It's been a nice rally. We rallied, what, $1.30 off the low. You go back here to December at $9.50. We had a lot of us talking about maybe putting an 8 in front of this thing. But with the Argentine dry weather coupled with the USDA reducing our crop size, you know, that's really given a boost to this thing and brought us back to the 200-day moving average, which we had not been above that until yesterday, since back in December of 23. So we had spent, what, 14 months below the 200-day moving average. Finally got above it yesterday, started higher this morning, ended up now we're down again. So maybe this thing's starting to correct a little bit. We'll see. I've been telling folks for 2 months now, probably 3 months now, that I wouldn't want to hold a bean past the end of January, because I don't want to hold my beans and try to compete with the Brazilian farmer going forward. And here we are, February 5th. So I wouldn't want to own a bean going forward. I think it's been a great rally. I'd cash it in. If you see a setback and you want to get back in the market, go buy an out-of-the-money call or something like that. But I think this is a fantastic opportunity that USDA has given us. Looking ahead to next year, 3 different scenarios. 85 million acres. That was USDA's baseline projection back in November. 83.6 would just be flipping back to a year ago. So if we just flip corn and beans back to where they were last year, and then the third one would be 81 million acres. If for some reason we planted a record corn acreage number, beans would probably have to drop to that level. But if you put in an 52 bushel yield, production would be ample. I'm expecting crush demand to be at a record high again next year. I think export demand probably will struggle a bit, assuming that Brazilian crop is as big as what they're saying it's going to be. And, you know, we don't really have a big deal here. You go from raisin stocks, 50 million bushels, to unchanged, to down about 100 million in that scenario. So maybe not ultra bearish. I just think it depends what happens in South America as we go forward. That's still going to be the big driver. How many acres do they plant this fall? I would anticipate they're not going to cut back. I think they're going to continue to raise more acres. So as we look at November futures, we were kind of hoping at this point we'd get back and put a 10 in front of this thing, and lo and behold, here we are, back to the 200-day moving average. Early this morning, traded back below it now. Kind of like corn. I think it's a great place to have some beans sold for next year, especially in lieu of the South American crop being as big as it is. And again, if you look at the number of rallies we get, we just don't get that many. So take advantage of the ones we get and start chipping in. I think we can make some money at 1060 beans today. I think it's a great place to get started on the sale for this year. And part of the reason for that, you know, if you look at the historical pattern of bean futures, you know, really from now till May, you know, that's when we tend to see our highs. And you get out past June especially, you know, the market typically doesn't look back. So the pattern's a little different for beans now than it is for corn, and I think that pattern's going to continue to shift as we continue to get this bigger and bigger chunk of the bean pie grown in South America. But certainly want to take advantage of the rally opportunities when we get them. So as we strategize for this year, again, I mentioned, you know, we put these puzzle pieces together. We've talked about the grain marketing side of it. From the insurance side, really we've got 3 different products that we're going to be talking about over the next 5-6 weeks. Revenue protection is on your farm. Supplemental coverage and enhanced coverage, those are county coverages. The price loss coverage and the PL and the ARC at the FSA office. Once again, we've got the 2018 Farm Bill that's been extended another year, so we get to make a choice between those 2 programs. And so this is kind of how they all stack together. I think Peggy showed you this graphic, but your individual coverage is right here. We've got SCO and ARC kind of cover that next piece, ECO at the top end, and then whatever you don't cover above that is your deductible. But just a few things about these programs. Revenue protection is based on your farm's APH. You can buy revenue protection up to 85%. SCO is county coverage that stacks above RP. Starts at 86% and goes down to where your RP level kicks in. So for example, if I buy 75 or 80% RP, then SCO is going to go from 86 to 75 or 86 to 80. ECO starts at 86 and goes up to 90 or 95%. And I'm calling this the blue light special this year because one thing the government did, one change for crop insurance this year. They came out back in November and it was in a spending bill, I believe. But we got the government to raise the copay. I'm trying to use the word copay, not subsidy. The copay for ECO this year from 44 to 65%, which equates on corn to maybe 10 bucks an acre. Beans is going to be about 6 bucks an acre cheaper than what it was a year ago. So to me, this is going to be a game changer, especially for producers that are trying to cover their cost of production. And even at 85%, I think that's going to be tough to do, but getting this extra bit of coverage might help you get that done and at a much cheaper rate than a year ago. So we'll see. The other reason I like ECO, I've always liked this as a put option. And if I'm not going to the marketplace and selling a whole bunch of grain today, but if I can buy a policy that's giving me 95% trigger, which means let's assume going into the year that my yields or the county yields are unchanged. Let's assume we have an average year. Then price only has to go down 5% to start to trigger a payment. And today, if we were at 467 on our base price, that's about 442 December futures. If we go down to below 442 or below, we'd be starting to get a payment back. So to me, that's how this acts like a put option. And if I'm not going to get aggressive forward selling, then I think this is one way that I can put a floor under the price. Looking at the FSA office, PLC is price protection only. Has no conflict with what you do on crop insurance. If I think corn's going below $4, beans are going to 8 bucks next year, I might want to sign up for PLC. If I'm just ultra bearish, want that price protection below me. Or I could sign up for the Ark County program. Ark County is a revenue-based program. It's an 86% trigger. It's a 10% maximum band of protection, but it cannot be coupled with SCO. So to me, the first thing you need to do this year is decide, am I going to sign up for the Ark County program? And if I decide yes, then I draw a line through SCO. Cannot do that. One of the most important things you can do today is figure out what your base acres look like. Because keep in mind, these pay on base acres. Crop insurance protects the acres you plant. If you want a program at FSA that's going to roughly protect what you intend to grow this year, then you need to see if your base acres match up well with what you're going to plant this year. Also, these programs pay on 85% of your base acres. These programs pay on 100% of your planted acres. So I think now is the time to be kind of seeing how ARC and PLC match up with what you intend to plant. So looking at the prices probably helps me determine which program I like the best. This year, all of the prices for the programs at FSA are going to go up a little bit. The crop insurance price, we don't know yet. We're setting that right now during this month. Those are the numbers in the green. The blue are the PLC reference prices. And so these numbers are going to come up as well. There's a multiplier clause in there. When the Ark County price goes up, PLC gets to follow. And the PLC price for corn's going to 426, beans to 966, wheat's going up to 556. So anybody that signs up for PLC, you're going to get a little bit of a bump. At the end of the year, if the market year average price ends up below these numbers, you would get paid the difference times your payment yield at the FSA office times 85% of your base acres. For the ARC program, we're going to use the numbers in red over here. And ARC finally gets the benefit of the 2018 Farm Bill, which had a 5-year Olympic average price built in. So while the markets have been coming down, for the Ark County program, we're going to drop the 2018 price, pull in the 2023 average this year. So these prices are going to come up. We're going to go up to 503, we're going to go up to 1217, and wheat's going to go up to 672. And if you compare ARC to SCO or the other crop insurance programs, you know, right now we're still 30 some cents higher for corn, beans are $1.50 higher, wheat's up 80 cents. So right now the ARC County program to me looks a lot better this year than that SCO coverage. Both are 86% county coverages. So as of today, if I have base acres of corn, beans, wheat that kind of match what I intend to plant, then I think ARC County is going to give me some pretty good support this year. And I do think this is something you have to look at every year. So we'll look at it again next year. We don't know if we'll get a new farm bill at some point in time. If we do, then we'll look at that again. So I built this spreadsheet to be able to compare the ARC versus the SCO, just to be able to see the math. And so if we were to buy SCO coverage, you do have to pay for it, but you would also then enroll in the PLC program at the FSA office. So if you combine those two programs, compare them to the county ARC. And I looked at an example, this is a fictitious county, but I just said we look at a price drop only. I'm assuming going into the year, we have an average yield. I don't know any other way to go into a year. But let's say that we start out at $467 as our base insurance price, and at the end of the year, the harvest price ends up at $420. Let's say the market year average price for the farm programs ends up at $420 as well. We calculate the value of our SCO coverage by subtracting 86 minus the 75 or whatever your RP level is. That's an 11% band times my expected value of the crop, which is the base price times my APH. So this SCO band is going to be worth $102 an acre. Let's assume that the county yield doesn't change. Expected county yield, final county yield are the same. So a 10% drop in price isn't enough to trigger a loss on an 86% policy. So SCO would not pay anything. In this case, because we went to $420, we're 6 cents below the PLC reference price. So you'd get 6 cents a bushel times your payment yield at FSA times 85% of my base acres. And I made the assumption that my planted acres are 1,000 and my base was 1,000. So I made the assumption those are the same. I guarantee that's probably not the case for most of you. But if I subtract the premium for SCO, add back in the PLC payment, I'm getting about $1,000 an acre. On this side, because we start with a 503 price for the ARC program, that makes our benchmark revenue $956. One thing to remember, the 10% of that benchmark is the maximum you can get paid for the ARC County program. So that's $95. Over here, SCO is worth $102, so pretty close. We said the price went down to $420 for the year. Yield didn't change. We ended up at $798. We had a $24 ARC payment times 85% of my base acres. In this case, I got paid $20,000. So in most cases, this ARC program is going to pay you better than what PLC would because we're starting at 503. And if I look at beans, it's going to be the same way because at 1217 compared to 1063, you know, over here we're getting a small payment if the price drops. Over here I'm getting about $49,000. So I can't come up with a plan that ARC doesn't really beat SCO. The only way I think that would be is if prices went in the tank, then ARC maxes out, but PLC and SCO, you're going to get more dollars to the downside. Or if you had a price drop, somewhat minimal price drop, but the county yield came in 20 bushel higher than expected on corn, it might offset itself and you might not have an ARC payment, but because of the harvest price option included with SCO, it might trigger a payment. But if you think we're going to say somewhere middle of the road, I think the ARC program is probably the better bet for this year. And so trying to build a plan then, we look at our producer profitability matrix. We've got our crop insurance decision on the left. Up here I've got my costs per acre, which I use $900 for corn. I guarantee everybody in the room is different than that number. Probably depends mostly on land cost. Forward sales right here in green. And so the first thing I looked at is an 80% RP policy. And so in the matrix down here, we've got yields across the top and prices, harvest prices down the left-hand side. and then you can see the combinations. The green is where we're making money, and the red is where we're not. 2 years ago, when we had $6.50 corn price, you could probably buy an 80% policy and lock in a profit. This year, doesn't look like that's going to be the case. And in fact, the worst case scenario today, if we get a low price and or low yield, you know, we're down to where we're losing $169 an acre. So what else can I do besides just buy an 80% RP policy if I'm trying to cover my costs? Well, maybe A, I sign up for the county ARC program, which will give me some protection downside. And then B, I definitely want to look at ECO this year. Because of that additional copay, and having that 95% trigger, and even after I take the cost out, you can see it enhanced, made my worst case scenario a lot better. It wasn't enough to cover $900 an acre, but it did give me a much lighter shade of pink, turned a few boxes green up here in the top left. But if I'm really concerned about downside on price, then I also want to make a forward sale. And I said if I forward sell half of my APH at $4.75 corn, I've got, kind of hard to see the colors, but all these boxes down here at the bottom now are green. We're green up here. We just have some pink right here where the yield went down, but the price didn't change. So this is where I encourage guys, know your own cost of production. You can look at your own situation. What happens if I add this, or what happens if I do this? To me this year, I like the idea of having my individual coverage at whatever level I feel best about. Some of you, it might be going all the way to 85%. Some it might be to 80. That premium drop from 85 to 80 is quite a bit, or 75 if that makes sense. Consider the ARC program to cover that middle band. I don't have that on here. That middle band that we showed earlier, use your ARC program to cover that, and then use ECO up at the top end if you want to really get a high trigger and get enough dollars to cover your cost of production. I think that's a good way to look at attacking this thing this year. You've got about 40 days to make that decision, so I think it starts with knowing your base acres and whether the farm program is going to be good to be able to protect that middle band of dollars of revenue for you. And so that's, to me, how this all fits together. Once again, we did hand out these green cards. It does show some of the marketing services that we've got available. I do an opening bell phone call every morning at about 8:40. It's a 2-minute phone blast on the markets. We do an email letter in the afternoon. If you're interested in getting one or both of those, you can put your information on a piece of paper, give it to one of us after the meeting. We'll be happy to get you hooked up. I do a monthly webinar called The Aftermath, the day following the USDA report. We do thinking cap videos. All of those are out on our YouTube channel. If you're familiar with YouTube, go out and type in NAU Country, and you can watch those anytime you want. So a lot of ways we want to get information out to the growers we're working with. So any questions or comments? Who's going to plant more corn this year? Anybody going to plant more beans? Okay. I haven't had anybody raise their hand on that one, so. Rotation, flip.
Yep.
All right, anybody got any more questions or any questions for Rich? Okay, well,
Thank you.
thank
Thanks
you,
for coming.
thank you, Rich,
You bet.
appreciate it. So as Rich kind of indicated and Peggy indicated, you know, with the margin, profit and margin being semi-tight, pretty tight, now isn't the time to be status quo. I think it's a good time to ask the questions, understand what is out there, and challenge your agent. I think that's one of the important things, you know, challenge Peggy, challenge myself, challenge really anybody, ask the questions and just make sure that, you know, status quo, sometimes that doesn't help pay the bills. So anyways, appreciate everybody coming out, drive safe. Hopefully the roads aren't too terrible bad, but hey, we'll hang around, ask us questions if you got anything afterwards, but thank you.